extraordinary music.
What's going on, Masterclass family? This is your boy, Mr. Adams, bringing you a Masterclass Entries video. I apologize for the delay, but due to the growth in our organization, I felt that it was definitely time to get a entries video done as soon as possible. So let's get right to it. I don't want to waste any time with this. All right, so at Masterclass, we have three primary entry strategies. There's only three ways that we can enter a stock. A stock is either going to be in a demand zone, a supply zone, or it's going to be a breakout. A breakout for calls or a breakdown for puts. First and foremost, the entry strategy that trumps them all is supply and demand zone. As you know from your studies, a demand zone is an area of value where institutions like to buy stock at a cheaper price. They're buying low and they're selling high, meaning they are selling stock in a supply zone. We also have a custom indicator that allows us to see supply and demand zones in advance, which gives us edge and somewhat of a competitive advantage because everyone doesn't have that feature and benefit. It is custom to Masterclass at this time. So to keep things simple, we simply buy call options when the stock price falls down to a demand zone, and we buy put options when the stock price rises to a supply zone. Simple. But there's a few other things that we want to take into consideration because we do have a weekly report card checklist that has criteria for demand zone trades, supply zone trades, and breakout trades. So now I'm going to get integrated detail on exactly what the criteria is. When we're looking at a stock that's either in demand zone or supply zone, one of the next things that we want to identify is some type of a reversal candle, which can be a doji, a hammer, shooting star, or some type of bullish or bearish engulfing pattern. And we want to see those reversal candles at a demand zone or at a supply zone to give the setup more validity. When we see a reversal candle at a supply zone, then that's another indicator for us to look at buying put options. When we see a reversal candle such as a doji, hammer, or bullish engulfing pattern in a demand zone, that's an opportunity for us to take a look at buying call options. Some of the best trades is when you see a stock is not only in a supply zone, but it may have a pivot point resistance level or a daily high resistance level there with it, giving it somewhat of a dual resistance type of level, followed by a bearish engulfing pattern, and vice versa with a demand zone that has previous days low as a form of support or pivot point low as a form of, or it's called S1 as a form of support as well, which is another dual type of support situation. So when you see a reversal candle or bullish engulfing candle there, that setup or reversal has more validity to buy calls and vice versa for puts. Now, the next thing that we add to increase our accuracy is we use a indicator on the Thinkorswim software called the slow RSI. Please respect my gangster with the way that I drew this RSI line. I did the best that I could, but it tells the story. And it's simple with how the slow RSI works. When the slow RSI is below this bottom line, which is like a 20 level, it's considered to be oversold. And when the slow RSI is oversold, we're simply looking to buy calls. Vice versa, when a slow RSI is above this line up here, which is typically an 80 level, we're looking to buy puts. So to keep it very simple, When the stock price falls and you see that the slow RSI is oversold, you're looking to buy call options. And vice versa, when you see that the slow RSI is overbought, you're looking to buy put options. So now let's put all of this together into one simple strategy. When you see a stock is in a supply zone, hopefully with another level of resistance, and then you're seeing that reversal candles are forming because price is being rejected by the supply zone, meaning that there's a bunch of sell orders sitting there waiting to cause the stock price to fall, and you also see that the RSI is overbought, then it's safe to buy puts. That trade is going to be what I call a LLH, low risk, high reward, and a high probability trade. The same thing works for uh, buying in a demand zone. When you see that a stock has fallen down to a demand zone, and hopefully you have another level of support there, it could be a moving average, but that's very rare. You're more likely to see previous day's low or a pivot point support. If you see one of those two things with the demand zone, and then you get a reversal candle such as a doji or bullish engulfing candle, and then you see that the slow RSI is oversold, that's a low risk, high reward, high probability trade to buy call options. Your entries really does not get any better than that. That's the best of the best entry that you could possibly get when entering the stock using supply and demand zones. So let's take a look at a few examples. Here's a chart of Caterpillar. Looking right here, you have two doji. You have a doji, somewhat of a doji, and a hammer. And this hammer reversal candlestick is right at our custom demand zone level with the previous day's low. So that's a dual type of support. And you can see that the slow RSI around the same time is oversold. So it's a good time to buy calls. And within the next hour or two, the stock increased to a whole $1.50. That would have been a great trade. Next, here's Microsoft. Microsoft fell down to a demand zone, formed somewhat of a reversal candle here, but it also had the previous day's low. So that's a dual support type of situation. And the slow RSI was oversold. Had you purchased calls, Microsoft went up $1 within the next hour, hour and a half. Easy to hit your target with that type of setup. Here's another example with Apple that fell to a dual demand slash support level. Bounced down, popped up for a good hour or so, retraced back to the level and held. The RSI was oversold the entire time, and then Apple took off, almost giving you a $2 move within an hour and a half. Here's an example of Google buying puts in a supply zone around 11:30. Google had formed this engulfing candle, just about. It's a huge red candle, while it was uh, overbought on the RSI. And shortly after, the stock eventually fell. And that's a pretty big fall for Google. And one of the beautiful things I want to bring to your attention is that I think a swim allows you to plot engulfing candles and dojis, and it will give you arrows sometimes. It catches about 85 to 90% of it, of those reversal candles. It doesn't catch all of them, but it does a really good job of helping you identify. Here's another example of a stock called Celgene. We have an obvious red supply zone here. We had an engulfing candle alert with a red arrow stating that this candle engulfed this candle. The slow RSI was recently overbought, and eventually the stock fell. So that's pretty much the criteria. But something else I want to bring to your attention is we don't necessarily want to trade solely off of the 5-minute chart for demand zones and supply zones. You want to take a look at a higher time frame to know that sell orders are actually going to come in because of some higher time frames, such as the daily chart resistance level. So here's a chart of Netflix. We can see that once it reached a high of 373.41, it was in a supply zone. There's a red candle underneath this bubble here, showing that this also was a bearish engulfing candle. And ultimately, Netflix fell. During that time, Netflix was also overbought. So it was a good time to buy puts. But something else that came to my attention when I looked at this, if you look at this doji candle right here, the high of this doji candle is touching this trend line or this triangle, and that's a form of daily chart resistance. Not to mention, if we look over back in February, around February 25th, the high of this candle was a huge point of rejection, and it couldn't break back above this level and hold. It attempted to a month later, broke over it, but closed right back below it. And now here Netflix is again on I believe this day was maybe 4 or 5. It attempted to break out, but it got rejected by this previous resistance level and this triangle resistance or trendline resistance, which is a form of confluence as well that rejected Netflix. So if we go back and we take a look at the 5 minute chart, we can see why it was rejected on a daily chart because Netflix ran into two forms of resistance on a daily chart. So when you're looking at a supply demand zone opportunity on a 5 minute chart, always quickly check to see if you have that confluence on a higher time frame, such as a daily chart, that's going to either hold it up as support or resistance. Let's take another look at that. Here's the next day where Netflix fell down into a demand zone. You got a doji right here, almost an engulfing candle, but it still can qualify as a reversal because of the doji. And you have a situation to where it's oversold on our side. And then Netflix eventually just took off. It ran about $5 towards the end of the day, which is a huge move. But what helped it work? This purple line right here is the 20-day moving average on Netflix. So as the stock had fell, due to previous rejection from resistance on the daily chart, it fell down to a up-sloping 20-day moving average. The yellow line is the 10-day moving average, which is above the 20, which shows that the current trend for the stock is still up, though it was recently rejected. So it fell down to the 20 moving average on the daily chart, which gave you an extra level or an extra layer of support, which would have gave you greater conviction to take the Netflix trade when the stock price fell down to this demand zone and being oversold. That would have gave you a low risk, high probability, high reward trade. Next, let's talk about breakouts. Because breakouts are really great to trade. You can make a lot of money, but breakouts are also known as fake outs. Real breakouts only work half of the time. And I found that the best way to trade breakouts majority of the time is waiting for the breakout to retest. What do I mean by retest? When the stock is at a support level, once it breaks down through that support level now becomes resistance. And the stock will typically test that new level of resistance before it goes lower. Uh, Likewise, if a stock has been trailing underneath resistance, the moment that it breaks out of that resistance, it will inevitably come down and test that resistance as a new support level before it goes higher. So buying those retests has proven to be far more profitable and gave you better entries for those trades. So let's take a closer look at how it works. So here's an example, if you will, of a stock breaking through a supply zone. Now, anytime you see a breakout, you want to see a stock breaking out with a higher value, where volume is increasing, not decreasing. If a stock is breaking out and volume is decreasing, that's not a good thing. You want to see your volume increasing as the stock breaks out. So in this simulation, if you will, you can see that the stock is breaking out with large green candles, which would be accompanied by a large value. Then the stock starts to decrease, what's called a pullback. Your pullback should have lower value. So after a breakout on high volume, your pullback should have low volume. That lets you know that this is not real selling taking place, at least not by institutions. So stock usually pull back 3 to 4 candles and then will retest a previous supply zone or resistance as new support or demand. That's called a zone flip. When your supply zone becomes a demand zone, and then it begins its next leg up or its next run. This doji candle here on the test of this supply zone, which is technically new demand, would be the ideal time to buy calls. On the flip side, let's take a look at a zone flip to the downside. So the stock price broke down through the demand zone on large value. Then it came up and it retested the demand zone as new supply zone on smaller value. And this is the time to enter puts on that retest. So for your breakouts, in most cases, you're looking for a retest of new support or new resistance. As it pertains to the lower indicators, such as the RSI and what we will also use the MACD, and sometimes do a money flow, you typically want those levels as close to the zero line as possible. So, for example, before I go into that, uh, just to reiterate, when the stock is retesting, it can retest either a demand zone, supply zone, pivot point, which can either be the R1 pivot, which is resistance, the S1 pivot, which is the green support, or the middle pivot, which is typically purple. The previous day's high or low level, moving averages, and VWAP. All of those indicators are all fair game for a retest as far as breakouts are concerned. And I use a concept called laddering as well. So for call breakouts, I typically want to see on a 5 minute chart that the 10-day moving average is above the 20-day moving average. The 20-day moving average is above the 50-day moving average, and the 50-day moving average is above the 200-day moving average. For puts, I typically want to see the 200-day moving average above the 50 moving average, the 50 moving average above the 200 moving average, and I'm sorry, the 20 moving average, and the 20 moving average above the 10 moving average. Because when the moving averages are structured that way and the stock price is above or below those levels, then all of those act as additional levels of support or resistance, which puts the odds in your favor. So here's an example of Netflix. At 9:30, this is a gold Mary setup on Netflix. Got a huge candle. It broke out here, but then came back and retested and consolidated for a good 30 minutes. And during that consolidation, the yellow 10 is above the purple 20 is above the blue 50 is above the 200. So it met our ladder requirements there. You're getting some small candlesticks on this retest, such as dojis, which is great. If you don't buy exactly on the retest, you want to buy on a smaller candlestick, such as a doji, to make sure you get the best price possible. You're not paying too much for your contracts. Down here, we have the MACD, which is just crossing positive in an area near the zero line, and the slow RSI level is near the zero middle line as well. So that's a great setup there for Netflix. And on that retest and pop, Netflix moved about $5 within an hour and a half. That would be an ideal breakout retest trade on Netflix. Here's an example of Delta. We can see that previously we had a red supply zone here from the day before. The stock broke out, came back and tested that previous level of supply as new demand, but that level also consisted of the previous day's high, which was resistance yesterday, and now it's support today, and the white line is VWAP. Uh, Plus, you got the 20-day moving average, which is the purple line. So all within this area on this retest, you have about 3 to 4 levels of new support that's holding the stock up, and that's why Delta went higher after that. The slow RSI is not always going to be uh, at the zero line, the middle line, which is this dash line here. I mean, that would be ideal, but as long as it's not greatly overextended, like at this point, if you catch it right when it's breaking the overbought level, that's perfectly fine. The same goes true when the stock is breaking down and it's right at the oversold level, because it still has plenty of room to fall when it's right at the level. But if it's extremely above or below that, then you want to stay away from that for breakouts. Let's take a look at a few more examples. So here's one of my favorite setups. This is our gold married setup. This is on Citigroup that has dual money flow. The stock immediately broke out. The second candle here, if you can somewhat see this wick that came back down to test the white VWAP line, that's a quick retest entry. Um, Sometimes you have the luxury of being able to catch that, because some stocks really won't pull back to give you that deeper test. It'll just be a quick touch to retest and then take off, and you can miss the entire move And this was a 5-to-1 trade on this particular day, so you wouldn't want to miss that move. So the good entry here would have been not, unless you bought immediately at the open, not buying on the large candlestick, waiting for the second candlestick to come down to test VWAP as a retest, then you're free to take that trade. Here's another example of a gold Mary setup with Southwest Airlines. We can see that the stock broke out with dual money flow. This red candlestick was a really quick retest here on all of those levels. So it's retesting the Mary levels, which is the daily high, the pivot resistance, the 10 moving average, and the VWAP with dual money flow, which gives you low risk, high probability, high reward trade. And that was a 5-to-1 move that day as well. It's all about looking for those retests. Here's an example of Amazon doing an earnings beat. If we look the night before, Amazon had tapped out around, this is an older chart, but it's around $1,055 as resistance right before the market opened. It gapped above it. Then what did it do? It came down and tested. On this chart, my blue line is the 10, the white is the VWAP, so I can not elaborate on that too much. You got the, as far as ladder is concerned, you got the purple 20, the dash 50, and the 200. So you got the ladder moving averages for calls. Then you got this candlestick that's retesting this level of resistance as new support, plus it's holding the 10, 20, and VWAP with the 50 under it. So there's 4 to 5 levels of support, and Amazon immediately took off and ran about, $50 that day, if not more, which was a huge move. I think it was like a 50 or 60 to 1 because it was on a Friday as well. So looking at this on the downside, here's an example of Tesla, where you have this large red candlestick where Tesla broke through the demand zone. So now that it's broken through the demand zone, what are you looking for? You're looking for the retest. So 3 candles later, you have this shooting star as coming up into this new supply zone of a level that used to be demand. It immediately rejected, and then it fell. So that was your retest entry here on Tesla, with the shooting star into this new resistance, and then it fell about $5 to $6. Huge quick move for puts. Sometimes the fall is sudden and the retest is quick. So here's an example of X Steel. This pivot middle line was the resistance. It didn't break the support. It didn't break that support yesterday. It actually held, so they had to gap it down. And guess what? They gapped it down ladder. You got the 10, you got the 20 above the 10, 50 above the 20, 100 above the 50, and the 200 above the 100. So it's laddered in chronological order as far as puts are concerned. This very first candlestick that's green, it ran up to retest, these levels as new resistance. So it retested only the pivot support as new resistance. It retested VWAP, the 10, and the 20, and the previous day's low. So there's now 5 levels of resistance for the stock, and it immediately plummeted, giving you a quick 5-to-1 on X puts. Those contracts probably went from like 10 cents to 50 cents within that first 30 minutes, which is a huge move. So that's the presentation for the Masterclass Entry Strategies. It's only 3 ways to enter. Breakouts. It's only 3 ways to enter. Demand zone, supply zone, breakouts. Your demand zone, you're looking for the stock, for the slow RSI to be oversold with the reversal candle and hopefully some other form of support. In the supply zone, you're looking for the stock to be overbought on the RSI, reversal candle, and hopefully another form of resistance. And on your breakouts or breakdowns, you want the RSI and the MACD to be as close as possible to the middle line, and you want to wait for a retest. The retest should have low volume. The breakout should have high volume. If you follow those rules and then immediately set your OCO, you should be good to go. There's absolutely no reason that you should fail trading. The only thing you have to do is be patient enough to wait for the ideal entry opportunities and just ensuring that it's a low risk, high reward, high probability trade. Masterclass. Dominate.